I gotta admit, I'm kind of happy right now. The markets are heading for a bit of a slump, possibly with more pain on the way, but I'm still getting paid. Welcome back everyone, my name's Paul. If you've never seen me before, I've recently started investing and I'm tracking it here on YouTube. Yes, I have had a head shave. Thanks for noticing. I just do it myself now. Saves a tenner. When I started investing, I needed to pick a strategy. Most new investors pick the growth strategy. This is a great strategy for making the most out of your money in the shortest amount of time, and it makes that big green number at the top that little bit greener. Personally, I've chosen the dividend growth strategy. The dividend growth strategy is designed to be a little bit safer. You make a lot of your returns by taking payments in the form of dividends, which companies pay you out of their profits. As far as market growth goes, you're only going to really see slow and steady growth, but the idea is that when we do hit a big slump, these companies aren't as heavily affected. I'm pretty amazed how successful this has been recently. The strategy seems to be doing exactly what it's supposed to be in our current situation. My investments aren't nearly as volatile as the overall market. When the market jumps up and down 3 or 4%, my portfolio is only going up and down 1 or 2%. But likewise, when the market jumps 5%, mine's only really going up 3 or 4%. And what's most surprising is I'm still earning dividends. I really did not expect that to happen during this economic shutdown. So today I'd like to take a look at how my dividend portfolio is faring up through this recession, and then I want to take you through how I'm looking for dividend growth companies by taking you through one of my newest holdings, which is called Raytheon Technologies. So let's take a look at how my investment portfolio is doing. My investments are currently sitting about 3% in the green. This is heavily underperforming the S&P 500 right now, which I believe is sitting around 6 or 7%. But that doesn't bother me in the slightest. What's great is how my dividend payers are holding up. 90% of my stocks are still paying dividends. It's only really the ones that are in retail and tourism that have kind of given up a bit. In fact, this month has been my most successful dividend month since I started. The majority of the big payers are still there, with Unilever, Johnson & Johnson, Microsoft, 3M, McDonald's, Realty, Tyson, Shell, and all the vanguards. The actual amount I've been paid isn't very much, but I don't have a lot invested yet. Hopefully as the years go on, those dividend payments are going to get much bigger. And I must admit, even I don't get it. During a full economic shutdown, I would have thought more companies would be cutting their dividends. Companies are earning practically nothing, except they're still paying out their dividends. Surely it should be much less, right? Everyone was predicting that all these big companies were going to cut and hoard their payments, all preparing for the big onslaught. So I had a good look at why the companies I'm invested in are doing so well as far as their dividend payments. It turns out it was pretty simple after all. The aim of the dividend growth strategy is to find companies with great balance sheets. They need to have great cash flows and great ratios, so in a downturn they still have cash available to pay dividends. I'm not going to be right every time. I'm fully aware of that, and right now I am holding some companies that have stopped their dividends. I completely understand why Diageo cut its dividend. Its balance sheet is only very good, and it's a company that has been heavily affected by economic shutdown. Disney is a little bit more annoying, because its balance sheet is excellent, and it's had all that success with Disney+. Disney definitely has enough cash to pay its dividend, even though it's taking on a lot more debt right now. But I do get it. Disney is laying off a lot of employees, and it would look pretty bad if it was still paying shareholders during all that. Disney has to heavily consider public opinion. Right now, I think it's changing the name of one of its most famous rides. That's fair enough. I'm guessing it's going to be a positive move for society and also a positive move for the company in general. But other than those two glaring ones, most of my companies are still paying their dividend. I'm using a pretty basic line graph just to track how my dividends are growing, and this month it looks like it's doubled. This is certainly a positive sign that this strategy is working well for me. And with continued investment and compounding, I can start to see the fire burning, and that's really reassuring for me. But I don't want to give you the impression that things are all rosy. Companies usually announce their next dividend at the quarterly earnings report. Famously, Quarter 2 earnings reports are fast approaching in July. And this quarter is when all the big companies are finally going to reveal how bad the economic shutdown affected them. There's a couple of scenarios that we might see out of Quarter 2 earnings. First, there's the doom and gloom scenario, where all of the earnings reports are much worse than expected. If we see some of the larger companies posting lower than expected revenues, we're likely to see dividend cuts and sell-offs right across the board. I don't see this on its own leading to a market crash, but it could lead to a big, long recession. My dividend-paying companies have really stood their ground through the first quarter, but they probably can't go on much longer. But then again, you could have the complete opposite. Revenues might go up, everything starts to look rosy again, and the world just goes back and blissfully glides into the next bull market. But yeah, that's not going to happen. Most companies have already warned us of their poor expected sales. If everything comes back on target, we're likely to see no change, and everything will just continue how it is right now. And swing traders will continue to have a great time right up until the day the Fed leaves us out to dry. None of this changes my strategy though. I'm not selling, I'm not taking profits, and I'm still on the lookout for some good dividend payers. And I'd like to take you through one of my newer holdings, which is Raytheon Technologies. Raytheon is traditionally a bomb and aircraft maker that's been affected heavily by the economic shutdown. On its defense side, it makes missiles and guns, and on the commercial side, it has a good range of small jets. Raytheon made the big time last year when it merged with United Technologies. This was a big deal, and overnight it made Raytheon the second biggest defense company in the world. From there, Raytheon's share price continued to climb until, well, you know what happened. But that's the past, let's look to the future. When I look at a stock, I try to look at it in two ways. I like to look at it from its numbers side, and I like to look at its ethos as well. If anyone out there is into critical analysis, this is known as the quantitative side and the qualitative side. Quantitative analysis is the things you can measure, like a company's balance sheet or their revenues. Qualitative analysis is the things that you can't measure, like a company's likability or their relevance to the market or their innovation. So let's take a look at Raytheon, how I would go through it. I do my best to find as much information as I can from the Trading 212 app. Sometimes Trading 212 isn't that accurate, or it's a bit behind, or it just doesn't have the graphs that I like to see. So I do sometimes go to different sites just to check that everything's right. First, as I've said before, I go to look at the ratios. Trading 212 states that RTX has a PE ratio of 8.7. I've seen that slightly different on other sites at about 12, but to me right now, because of the fluctuations in share price, I don't think anything is that accurate. All you've got to remember is that PE ratio is really a sign of how popular a company is. The higher the number, the more popular the company is. But you don't want it too high because that suggests it's too popular. We can see that Raytheon has a lovely dividend of 3.2%. This pretty much means nothing to me right now, other than it tells me that they have a dividend. I honestly don't understand why people will buy into a company just because the dividend yield is 12%. Rather than looking at the company and figuring out why their dividend yield is so outrageous. I head into the ratio section, and personally I don't look for anything more now than the financial strength area, and then scrolling down to current ratio and payout ratio. What I like to see is a company with a current ratio of over 1. This means it's not spending more than it's earning, and it's living within its means. And then I like to look at the payout ratio, which tells me how much money is being spent on dividends. I love to see a company with a payout ratio of about 60%. That number is pretty much arbitrary, it kind of means nothing, it's just a number that I popped out of my head because I like to see a company with about 40% of leeway for its dividend. I just feel that 40% is a good buffer for hard times, and a great sign that they're still able to invest for the future. Then we come down to the income statement, and what we want to see is those revenues going up every year. With Raytheon we do see this. 2020 is a totally different story though. But what I'm looking for right now is that Raytheon was a very good company prior to the market crash. And I'm satisfied that it was. Then I head to the balance sheet. I'll take a sneaky look at the first 3 numbers that we see. What I'm doing here is I'm just checking that they do have enough assets to cover their liabilities, and I'd like to see that debt to asset ratio as low as possible. Raytheon is showing a 70% debt to asset ratio, which is kind of high. This isn't great news, but it's not really worrying to me because I know they've got a lot of cash. There's not a lot I immediately look at on Trading 212 as far as the balance sheet goes, but I do like to see the cash and short-term investments going up nicely year on year. Raytheon is a little bit mixed here, but it spent a lot of cash on the merger last year, so I'll give it a little bit of leeway. Then we can scroll back up to the top and look at the growth performance. That's nice. It looks lovely growing year on year, but it doesn't mean that much to me. Really, I'm just looking that it's not in constant decline or it's not too cyclical. So it's nice to see that Raytheon is consistently growing, but let's get to the juicy bit, the dividend. As a dividend investor, I want to see how dedicated a company is to keeping its dividend. I'm looking for a company who loves paying them and loves increasing them as well. But at the same time, I want to know that the company is secure enough to keep paying it, and it's not just paying it to keep me on board. That's why we look at the balance sheet. It's also one of the reasons why I'm into Shell rather than BP, because Shell was just able to admit that it can't keep paying its dividend, and it cut it, whereas BP just did it a bit late. As we saw, Raytheon has a good payout ratio, so that suggests that it's covering its dividend well. And if we have a look on Seeking Alpha, we can see that both United and Raytheon have consistently paid increasing dividends since the early 90s. This is a big positive for me because it shows that this company has been safe and consistent with its dividend and not just raising and cutting its dividend whenever it feels like it. So based on Raytheon's fundamentals, this would have been a really good company for me to invest in prior to the economic shutdown. And right now it probably is too. What should be screaming at investors right now is that Raytheon's market price is still well below fair value. Raytheon is one company that has not recovered yet from the market crash. It's still probably $15 below its target price. Almost all of the top analysts are rating Raytheon between $75 and $80. And the current price of Raytheon is around $60-62, which means it's heavily undervalued. This is great news if you're one of those investors that doesn't think a market crash is coming or is just not bothered by one. I feel that Raytheon right now is one of those stocks that is still on a discount. So that's the basics of my quantitative research. But what about the qualitative ones? What makes the company good for the future? Raytheon Technologies is a bit of a mixed bag company. It's about 70% aerospace, as in it makes aircraft, and it's about 30% defense, as in it blows shit up. The defense side looks solid. There's loads of back orders, the production line is back up, they'll be back to blowing shit up in no time. The other 70%, that's the tough part. While it makes some of the best jet fighters known to man, it also makes some smaller commercial aircraft. So at the moment you can lump it into the same category as the airlines. No aircraft are moving right now, so the likes of Boeing and Airbus and Raytheon aren't making any new planes. It feels like to me that the smart money has lumped Raytheon with all the crappy airlines and figures that Raytheon isn't going anywhere for a long time. And at the same time, the dumb money just doesn't understand what Raytheon actually is. So my only explanation why Raytheon hasn't really moved yet is because it's in this sort of weird limbo. Just the other day, Gregory Hayes, who's the CEO of Raytheon, spoke to CNBC about its recent troubles. To me, he was pretty convincing. Just have a look at some of the highlights I picked out.
Look, the aerospace businesses, the legacy Collins and Pratt businesses, they're going to have a tough year. We're going to see sales probably down 50% or so on the commercial aero side. Keep in mind, though, that both of those businesses have a pretty solid defense portfolio as well, about 30% of their businesses. So, we weren't going to go bankrupt if we stood on our own. We would have probably been close to break even for the year from an earnings standpoint, but we certainly wouldn't have been looking to get a handout from the government. I should point out, we've got 195,000 employees across Raytheon Technologies, and about 95,000 of those folks are working from home, but I've got another 100,000 that are still showing up to work every day to build product and to support customers. And as we had the conversation with the board, we went through a lot of different scenarios and said, how bad can it be? And even in the worst case scenario that we put forth, we still had adequate liquidity to fund the dividend for the next 3 years. There is just so much unknown out there. I could not possibly recommend to the board to do share buybacks this year. In this environment, borrowing to do share buyback just doesn't make a hell of a lot of sense. So we're going to keep our powder dry, and we're going to look for opportunities. And if the stock continues to lag under intrinsic value, we'll be in the market, but it won't be this year. The recovery will happen. But the ultimate, the bad news is the month of April. And I think everything will get better from there, assuming we don't have a big resurgence in the number of cases and hospitalizations.
Part of the promise to shareholders of this deal was significant returns of capital to those shareholders. You're putting that off a bit right now, aren't you? I mean, I believe the 18 to 20 billion you've talked about last June, you're now saying is going to take place over 4 years versus 3 years. Why?
Why?
So there's a few things to take away here. Firstly, he says that there's a nice backlog of orders that are keeping Raytheon going. There's still business flowing through the company. A quick search shows that there's lots of new missiles and testing going on. The Raytheon United merger brought together two huge talent pools of engineers, and they're working together right now to improve all of Raytheon's product line. Secondly, he admits that the airline industry is going to take a long time to recover. It tells me that if you're going to be investing in anything that flies right now, you need to be investing in solid companies, not flimsy ones that are going around looking for handouts. Raytheon seems like it's got its head screwed on. I like this guy. He's telling it how it is. He isn't hiding anything. Well, he's part of the corporate machine, so he's hiding something. But it's probably just a death. But in this video, he makes it very clear that they're not doing any share buybacks. This will likely hurt the short-term share price, but Raytheon says very clearly in the video that the next 3 years of dividends are fully covered. This is exactly what I'm looking for. It's a solid company with lots of cash flow, and rather than inflating its own share price with stock buybacks, it's dedicating itself to the dividend. All these things like their product range, their leadership, their dedication to the future, these are all great examples of qualitative analysis. This is the stuff you can't measure with numbers. Raytheon is about as close I want to get to the airline sector right now. I don't feel like it's in the same boat as the airlines, and I would argue that it's even more healthy than Boeing right now. The positives of Raytheon outweigh the negatives in my opinion. On the plus side, you have a company that's solid in its foundations and pushing forward knowing exactly what its investors want and what its customers want. On the negative side, you have a company that is slowly increasing its debt due to its suffering heavily from the economic shutdown. You also need to consider your ethics when you're investing in a company like this. It's very easy to forget that when you're buying and selling on an app, that this company actually does its business by inflicting pain so other countries can get what they want. They call it defense, but let's call it what it is. However, all major corporations suffer their own ethical issues, and I would argue that some of the more innocent looking companies produce more death than some of the military ones. To me, Raytheon Technologies is a solid company that's dedicating itself to its dividend even through poor economic times. This is kind of exactly what I'm looking for and exactly what the dividend growth strategy is all about. So while it's still under $70, I'll be buying a lot more. This one has been a lot harder to make. I'm exhausted after this one. Right, just to end the video, because that was quite a lot of heavy detail, let's play another game of Is It Shit? Airline Edition. None of this video is intended as financial advice, it's just to generate a good discussion and a bit entertaining. I always look at stocks from a position of safety, so you might have a different idea if, say, you're a growth investor. This is merely a little bit of fun at the end, just to shout my opinion into space. So let's get started with Is It Shit? Airline Edition. I want to start with a crowd favourite, Rolls-Royce. Is it shit? Yes, I thought Rolls-Royce made cars, but they don't. They make engines. More specifically, they make aircraft engines. What's nice is they are able to diversify during the bad times. But I really don't know. That profit margin looks really sketchy. Next up, Airbus. Is it shit? Airbus is probably the only other stock that I'd invest in that produces wings. The industry is suffering, but Airbus hasn't been involved in any crashes recently. Okay, it hasn't caused any accidents and then tried to cover it up. Which brings me on to Boeing. Is it shit? No. It turns out you can crash a lot of planes and then try and cover it up, and no one cares. And finally, on the Is It Shit Airline Edition, we've got EasyJet, IAG, Jet2, Virgin, Delta, Finnair, Norwegian, Lufthansa, Air France, and all the others asking for a handout. Yes, you're fucking shit.
Why?
Even big airlines go bust during a good economy. Without a huge overhaul, this stuff is going to continue to happen. To put it simply, the airline industry is always on the brink of problems. It's always running on fumes, barely making a profit, always getting into more debt, and not thinking about resilience at all. So as far as airlines go, I know they'll come back, but this shit's just going to happen again and again. Thanks very much for watching, guys. If you're interested in investing, I use the platform Trading 212. There's a link in the description below. If you click that link and sign up, you get a free share, and one of my subscribers gets a free share as well. You can catch up with everyone on the Discord. They'll all probably be telling me how stupid I am for ignoring the airlines. And if you enjoyed this video, found it entertaining or useful, please feel free to like, subscribe, and invest.
Why?